Hello, everyone. Welcome back. You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings without the corporate PR filter. Today is Tuesday, January 13th, 2025, and we are looking at the big one, JP Morgan Chase, fourth quarter of 2025. Just a quick reminder before we start that we're just two friends looking at numbers. This isn't financial advice, just our personal opinions, so please do your own research. Miro, usually Jamie Dimon walks into an earnings call like he owns the place, but this one felt a little different.
Yeah, he still owns the place, but the rent just went up. Look, this was a trust me quarter. That's the headline. Net income dropped to $13 billion, down about 10% from the third quarter. Revenue was basically flat at $46.8 billion, but the real story isn't what they earned, it's what they spent and what they're planning to spend.
Right, because the headline IPS came in at 463, which is a pretty decent step down from the 507 we saw in Q3. And the market did not love that.
No, definitely not. The stock sold off pretty hard right at the open, closed down over 4%, around 310, which is interesting because it actually rallied into the end of the year. So this erased basically the last few weeks of gains in a single session. Investors looked at the guidance and said, wait, you want how much money next year?
Yeah, sticker shock. It feels like there were two massive anchors dragging on the numbers this time. One is this Apple Card deal, which sounds cool on paper, but looks expensive right now. And the other is this honestly kind of eye-watering expense forecast for 2026.
Exactly. That's the 1-2 punch. On the one hand, they took a $2.2 billion hit for credit reserves, basically pre-booking the pain for the Apple portfolio before they even fully have it. And on the other hand, Dimon is telling everyone that expenses are going to hit $105 billion next year. That's a lot of bankers and servers.
105 billion, that's basically the GDP of a small country. So it's messy, but it sounds like intentional messy, like they're clearing the decks?
It's strategic pain, or at least that's the pitch. But when you tell Wall Street, trust me, while asking for an extra $10 billion in spending, you better explain exactly where it's going. And I'm not sure they totally did.
Okay, that's the hook. Let's dig into what those numbers actually mean and whether the trust me tax is worth paying.
Right. So let's look at the actual bill before we worry about next year's budget, because if you strip out the noise, the core machine is, weirdly resilient. They posted earnings per share of $4.63. That's down from $5.07 last quarter, but net revenue was practically flat at $46.8 billion.
Which, considering the panic over the stock drop, doesn't sound catastrophic, just stagnant.
Stagnant on the surface, but underneath the tectonic plates are moving. Here's the thing that stands out. Net interest income, the money they make from lending versus what they pay depositors, actually went up. It hit $25.1 billion, up 4% from the third quarter.
Wait, hang on. The Fed cut rates 3 times recently. Usually that squeezes the bank's margin. How is JPM making more money on interest when rates are falling?
Volume and leverage, Susie. Deposit balances went up, but more importantly, revolving balances in card services are higher. Basically, people are carrying more debt on their credit cards, and JPM is collecting the interest.
Right. So the resilience is just the American consumer not paying off their bill. That feels less like a victory lap and more like a warning light.
Welcome to banking. But that credit card story is actually the main villain of this earnings report. The provision for credit losses spiked 37% to $4.7 billion. And almost half of that, $2.2 billion, was just for this Apple Card deal.
Okay, that's the pre-booking you mentioned earlier. It's like paying for a massive home renovation before you've even signed the deed. They took a huge hit to the consumer division. Net income there dropped to $3.6 billion, down almost $1.5 billion sequentially. That's the Apple tax right there.
Exactly. They wanted to clean up the balance sheet now, so 2026 looks prettier. But look at the other side of the house, the investment banking. Investment banking fees were actually down 11% quarter over quarter.
Oof, I thought deal making was back. Everybody's been talking about M&A waking up.
It is waking up, but it's hitting the snooze button. Closings are getting pushed. But, and this is classic JP Morgan, the traders saved the quarter. Equity markets revenue was up 40% year over year. So while the bankers are waiting for phones to ring, the trading desk was printing money.
There's something comforting about that. When in doubt, let the volatility desk handle it. So just to recap the snapshot, consumers are borrowing more. The Apple deal cost them a fortune upfront. Investment banking is slow, but the traders are having a party. And expenses for this quarter were actually fine.
Yeah, ironically, non-interest expense was $24 billion, down slightly. They actually controlled costs in Q4, which makes the guidance for next year even more jarring. They proved they can be disciplined. They're just choosing not to be.
It's a choice. That's a polite way to put it. But there's one number you mumbled earlier that I want to circle back to. You mentioned something about capital ratios dipping.
Yeah, the CET1 ratio, basically their safety cushion, dropped to 14.5%. It's still safe, don't get me wrong, but it's moving in the wrong direction right as they're promising to spend $105 billion.
All right. That feels like the pivot point. They're spending like a tech company, reserving like a cautious bank, and telling investors to just trust the process. But looking at the slides, there's one specific slide they included that feels defensive, like they're trying to hide an elephant in the room.
Oh, the private credit slide. Yeah, we definitely need to talk about that because that's not just a number, that's a philosophical argument with the regulators.
Okay, so the defensive slide. Usually banks try to bury their risks in the footnotes, not put them on a dedicated chart in the main deck. Why highlight it?
Because the regulators are circling the wagons in private credit. There's this narrative building in D.C. that the next financial crisis is going to come from shadow banking, non-bank financial institutions, or NBFIs. So JPM put up this slide to basically say, move along, nothing to see here.
These are not the droids you're looking for, defense.
Exactly. But look at how they did it. It's a definitional magic trick. They claimed their risk, exposure to the sector, is only $160 million, which sounds manageable for a balance sheet their size. But to get to that number, they explicitly excluded subscription finance, lending to private equity funds.
Wait, hang on. Lending to private equity is kind of the definition of the thing people are worried about, isn't it?
It is, but JPM's argument is, look, these loans are secured by uncalled capital commitments from investors. It's collateralized. It's safe. So they narrow the definition of risk to exclude the biggest growth area. It's clever. They're trying to stop the Fed from slapping higher capital charges on that whole bucket of lending.
It feels a bit like saying, if we don't count the calories from the cake, the diet's going great.
Right. And honestly, they might be right on the credit quality. Historically, those loans perform well. But the fact that they felt the need to dedicate prime real estate in the presentation to argue about definitions, that tells you they're feeling the heat. And that defensive posture on capital rules, it contrasts wildly with their attitude on spending.
Yeah. The $105 billion question. We touched on it earlier, but can we just sit with that number for a second? Jamie Dimon is guiding for $105 billion in expenses for 2026. That is a $10 billion jump from last year.
It's staggering. Most banks right now are fighting for every inch of efficiency. Citigroup is cutting, Wells is cutting, and here's Jamie standing on the mountain basically saying, we are going to spend more than the GDP of Kenya, and you're going to like it.
And he wasn't exactly apologetic about it on the call, was he?
No, he was Jamie. When an analyst pressed him on where exactly that money is going, is it AI? Is it branches? Is it tech? He literally said, quote, you're going to have to just trust me.
Trust me? That's a bold line when your stock is down 4% on the news.
It's the trust me tax. He's telling the market, I'm building a fortress. I'm worried about competitors like Stripe, SoFi, Revolut. I'm not going to let JP Morgan become a dinosaur because we tried to save a few pennies on tech. He even had this line about how in 10 years, nobody wants to ask, how did JP Morgan get left behind?
Which is fair. I mean, playing the long game is what you want a CEO to do. But it feels like there's a thin line between visionary investment and just
like bloated empire building. If revenue is flat and expenses are up 10%, the math gets ugly pretty fast if that growth doesn't materialize.
That's the risk. It's pure operating leverage in reverse. If the revenue environment softens, if rates drop faster or loan demand dries up, that $105 billion is a fixed anchor. You can't turn that ship quickly. It's hubris. It might be earned hubris because, it's Jamie Dimon, but it's still hubris.
It's like he's betting that he can outspend the disruption. So, yeah, let's step back for a second and think about what all this means going forward. Does the machine work with this much weight on it?
It works, but the margin for error just got razor thin. If you're going to run a $105 billion expense bill, the revenue engine cannot sputter, not even for a quarter.
Right, because they're guiding for net interest income to hit around $103 billion next year, which is growth, yes. But it feels like they're burning the furniture to keep the house warm. If rates drop faster than they expect, that math gets tight.
That's the vulnerability. They're betting on a soft landing plus massive market share gains. And don't forget the execution risk on this Apple deal. Jeremy Barnum said the capital impact, that massive RWA bloat, will drop in the near term. But integrating a portfolio that size over 2 years?
Yeah. Near term is banker code for hopefully before you get mad again. So it feels like 2026 is going to be a construction year, There's scaffolding everywhere, it's noisy, it's expensive, and investors just have to trust that the building underneath is actually getting better.
That's a good analogy. It's a renovation quarter. Look, my takeaway is this. JPM is trying to decouple itself from the rest of the banking sector. Everyone else is shrinking to survive. JPM is spending to conquer. It's arrogant, sure, but historically, betting against Jamie Dimon's arrogance hasn't been a very profitable trade.
No, he usually wins the argument eventually. But I think for the next few months, the market is going to keep asking for receipts. They're in the show me phase now.
Exactly. We need to see that provision expense stabilize, and we need to see that expense growth actually driving revenue, not just, inflating the ego.
Well, if anyone can pull off a $100 billion pivot, it's probably them. But it's definitely not going to be boring. All right, I think we've covered the renovation, the bill, and the leaky roof.
And the trust exercises.
Let's close this out. And that is officially a wrap on the numbers. But before we go, I want to take a moment to pull back the curtain a little bit. Because Earnings Unscripted isn't just a finance show. It's an experiment.
A bold one.
It is. We are a project run by a small team of human enthusiasts, exploring the frontier of generative AI, trying to see how it can be used to actually enrich us, not just automate us. This entire episode was created by a team of AI agents working in a workflow. From the research analyst crunches the raw 8Ks to the scriptwriter, the fact-checking QA specialist, and yes, even the voices you are hearing right now. We're all working together to deliver high-quality, up-to-the-minute information that would historically take a full newsroom days to produce.
And hopefully we make it sound a little less boring than a newsroom.
That is the goal. But because this is an experiment, we are still learning. We genuinely want to know what you think. Did we get it right? Was Miro too cynical? Please reach out to us at earningsunscripted@datamadness.ca or follow the project on X. Thanks for listening, and thanks for being part of the experiment.
And see you after the next call.